Part 2, KESO Intermediate Accounting, Chapter 4, Part 2. Now what we're going to do is take the information from the income statement in Part 1 and prepare earnings per share, a statement of retained earnings. Then we'll look at other comprehensive income, and then we'll talk about what happens when something changes. What do you do in terms of financial statements? First, earnings per share. We're going to take the net income minus any preferred dividends, and we're going to divide by the weighted average of common shares outstanding. Now, we cover this more further on in the text, but in this particular case, we're just doing a basic calculation. We're not going to figure out how to do a weighted average. We'll cover that later. So why do we need or look at earnings per share? Well, they consider it a significant business indicator. It measures the dollars earned by each share of common stock, must be disclosed on the income statement, and must be broken down between income from operations after tax and discontinued operations, because they want to get a better feel, and non-controlling interest because they want to know what effect that had. And then you show it based on net income. All right, now what we're going to do is we're going to go back to our example from Part 1. And we're going to see, do we have the information to determine earnings per share? Well, first of all, what we're going to do is we're going to look for our net income. We're going to look to see, are there any dividends? And we're going to look to see what are our shares of stock. So now what we can do is calculate earnings per share. So we look at our income statement that we prepared from Part 1, and now we can do the earnings per share of $2.66. Now, is this good? It depends. What you'd have to do is go back and look at prior years, and then you would compare it to how similar companies are doing. That's how you determine if earnings per share is good. And again, the double line means we stop the total. So that's what we do in accounting. Whenever we come to the bottom, we double line. All right, now we're going to do the statement of retained earnings. We're going to look for the beginning retained earnings balance. It can be plus or minus. If it's minus, it's called a deficit. Then we're going to look for any adjustments to prior year earnings. This would be plus or minus, and they're treated as an adjustment to beginning retained earnings. Then we're going to look for net income. We're going to add net income, subtract loss. And then we're going to look to see were any dividends declared or declared and paid, and we're going to subtract those out. So we go back to our example, and what we're going to do is we're going to look to see what is our balance at the beginning of the year. Then we're going to look to see, are there any prior year adjustments, which there are. We then look to see, have any dividends been declared, and they have. And then last, we also need that net income. Now we have all the information we need to prepare the financial statements. Here's what it would look like. We take our retained earnings balance, we would subtract out the depreciation that's understated, which means we didn't take enough out, so now we have to back it out. We get adjusted beginning retained earnings, and that should say January 1st, not December 1st. And that gives us net income. We're going to add our net income, and then we're going to take out the dividends, and that would give us the retained earnings December 31st. Now, if we were to do a single step income statement, this is what it would look like. We'd include all the revenue together and all of the expenses together. So as you can see, it doesn't give you as much information as a multi-step income statement. Of course, you always get the same number. Now, another thing we should talk about is other comprehensive income. This is a separate category, and usually it's shown as a separate statement following net income. It includes items that bypass the income statement, and they're always shown net of tax. One example would be any unrealized gain or losses on available for sale securities based on adjustment to fair market value. We cover that later in the chapter. Any gains or losses due to revisions in pension plans. Any changes due to any derivatives. And gain or losses from changes in foreign currency exchanges. That's another example. Now, under the international standard, they have one more, which is 5, which would be any adjustments to fair market value of fixed assets. Now, currently, we don't do that, so we don't have that category, but they do under the international standard. The last thing we're going to cover is what happens if things change. First, what happens if we decide to go from FIFO to LIFO, which is one acceptable method to another acceptable method? What we would do is have to treat that retroactively. We would have to do an adjustment to beginning retained earnings, and then we would have to go back and adjust prior years. 2 years on the balance sheet, 3 years on the income statement, so that people can make good comparisons. What if we have a change in accounting estimate? An example would be is we decide to increase or decrease our allowance for doubtfuls or our warranty reserve. Another item that's included in this category is if we go from one acceptable depreciation method to another acceptable depreciation method. This is called a change in accounting principle that's treated as a change in accounting estimate. And these types of changes are always treated prospectively. There is no adjustment to beginning retained earnings. All we do is change the current year and forward. The next thing that we can have is change in reporting entity. This is when we go from owning less than 20% of another company's stock to owning more than 20%. Or if we go from owning less than 50% or less to more than 50%, we're going to have to change how we present that on the financials. If we go from owning less than 20% to more than 20%, we have to adjust the investment account. If we go from 50% to more than 50%, we have to do consolidated financials. And to do that, we have to go back and restate prior years so that there can be comparisons. This is always treated retroactively. Now, the last thing we have here is errors. Errors are always treated retroactively if we find a mistake from a prior period and as an adjustment to beginning retained earnings. That ends Chapter 4.